Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stock Darts, and we will do what we normally do on Wednesdays, which is take a look at the four major markets. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the U.S. dollar, see how it's behaving, see if it's affecting gold, silver, or oil in any way, and then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat. I'll be more than happy to take a look at it when I get a chance. Hi Ray, welcome. Glad to have you in here. Glad to have whoever else is in here as well. Hopefully we'll get a few more people trickling in. If you guys like what you see here, you can always follow me on Twitter at StockDarts. You can visit YouTube and find me on StockDarts as well, or you can go ahead and visit me at patreon.com/StockDarts, where I post weekly blog content. I typically put either trade ideas or watch list ideas on Mondays, and then repost these things on Wednesdays, and sometimes I'll fill in a specific trade idea during the middle of the week if I see something that's appealing. But mostly it's a way for you to follow the types of actions that I take based off of my recommendations during these Wednesday market reviews. Other than that, let's go ahead. We can get started. First thing we're going to do is take a look at SPY, the ETF that mimics the S&P 500. As you can imagine, things aren't looking that great. We've had another pretty ugly start to the week. Yesterday we had a nice bounce and looked like maybe we had finally found a bottom, but we are back below most of yesterday's price action today. We're still above the Monday lows, so there's still hope that maybe we've finally put in a bottom, but as you can imagine, with the coronavirus fears spreading even more and more widely, and with the virus itself spreading, the market's still pretty spooked. And as I mentioned, for the last couple of weeks now, I don't know that we've seen the end to the selling yet, and I don't expect it to end anytime soon. Even if we do get a bounce, I think that we've hit enough of a snag in the markets that we will continue to see downside, or at the very least sideways price action over the next probably couple of months, at the very least until the next earnings cycle, and probably beyond that once we start getting some guidance reports from companies that they're going to start giving us a better idea of just what kind of impact we've had with just the economic slowdown we've had even now. I mentioned this last week. Even if we came up with a vaccine for the coronavirus today, there's still been enough of a slowdown in the market that it's going to have an impact on these companies and on their earnings reports over the next quarter and possibly beyond. So we've reached the point where it has made a pretty significant dent on our overall market and our overall economy, and now it's just a matter of seeing how much of it is going to affect the stock market. The stock market's usually looking forward, so a lot of the drop that we're seeing now is in anticipation of a lot of the slowdowns and a lot of the revised guidance or lower earnings reports we're going to see in the next earnings cycle. So it's not really the end of the world yet, but things are definitely a little bit more worrisome. And as we'll see as we go forward and look at these four major markets, we've started to go through some pretty critical technical levels that I consider to be important. So it's another warning sign that the market has definitely turned around, and at this point is a little bit of a danger to anyone that's in it now. That being said, I find it difficult to go ahead and try to raise cash where we are right now because we have dropped so much recently that I suspect that we should bounce a little bit more substantially than we've already seen, hopefully in the next week or two, and that'll give you a better opportunity to go ahead and raise some more cash, or to put yourself in a little bit more of a defensive state in your holdings. If we look at the S&P 500 again, we look at SPY, and you can see where we are right now. We sliced right through a pretty critical zone, which is this 305 to 304, down to about 295. And for us to get a better picture of that, we need to go ahead and look at a weekly chart. And you can see just where we are right now in the long term. Now, as you can imagine, in the long term, despite just how ugly all this has been, we're still in a market that has climbed pretty steadily for a long time now, right? And if you really look at where we are, I mean, we're still pretty much in the middle of the range that we've spent most of 2018 through 2019 in. So almost 2 years of price action. And while it's obviously a shame and it's pretty ugly that we were able to break out and give back that breakout in a couple of weeks, technically we're still right back in the base of the price action that we spent a pretty good portion of time in. Now, I don't want to go back in there. The last thing you want is the market to go backwards. Typically, when you start to see the market go backwards like this, that's a sign that we might have an impending top coming, or we might have a market that's going to have to shift in another direction. Now, it doesn't always happen. You can see we kind of went backwards at the end of 2017. The end of 2018 as we started to drop, and then we turned around, and last year we just rallied right from the beginning and continued rallying pretty much throughout the entire year up to right about now. So this could be another scare similar to that, where we end up turning around and rallying right back through highs. I don't think it's going to be the same scenario. But as you can see, even if the market does go backwards, and what I mean by that is typically you don't want to create new lows, right? So we had a nice little low area here that we found the support back in the beginning of 2018, and at the end we went below that, right? So that's what I mean by going backwards. We lost a lot of the support that we had already established as a good value area for the bulls to buy, and we lost that. And typically that's a bad sign. That's a market that's starting to surrender a bit to the bears, and usually leads to, if not a rollover, at the very least sideways price action until it starts to really test those support areas over and over and over again, right? We didn't get that. We actually got a strong rally that lasted basically an entire year, and finished right about about a month ago. And so we've come back down. We haven't gone backwards as far as losing those lows from 2018. So we're still okay as far as the bigger trajectory is concerned, as far as the bigger picture is concerned. But as you can see, we've lost a lot of ground recently. And considering that we haven't really seen what I would consider to be the end of the selling, there is room for us to come all the way back down and start testing these 250s and hopefully not lower, but possibly a little bit lower than the 250 area as we come back and test the bottom of that base. And that's unfortunately the reality we find ourselves in now, which is we've come back into this base, which means that the bottom of it is fair game. And if anything, it probably will happen at some point this year. And with the speed that the markets are going, I mean, it could happen pretty soon, although I think that we are getting close to bottom, and I'll give you a little bit of analysis why I think we might be ready for at least a short-term bounce when we get back to the daily chart. But overall, as you can see, we've hit a point now where we're right back in the middle. All these areas we sliced through are now going to become resistance. So we've got a lot of overhead resistance that we're going to be dealing with on the S&P 500 and really the markets overall. This 294 area, which was the ceiling for a couple of years, is again going to be a major area for us to try to break through. This area around 302 to 303, which was pretty critical, will also be important. And then, of course, if we somehow made it all the way back to 320, that is going to be a major level of resistance. But at this point, it's pretty clear that's not really in the cards right now. I think what's in the cards right now are the areas that we just sliced through. As far as a bounce goes, that's what we should be looking at as far as resistance and as far as just where we can expect the market to probably roll right back over once it hits those levels. So if we go to the daily chart, we'll see what that looks like on a shorter term time frame. And as you can see, if we do get a bounce coming in the next week, or maybe the end of this week and into the beginning of next week, we probably should not expect something past this 294 to 303, 304, 305 area, right around the 200 period moving average. I don't think that we're going to get past that. I don't expect us to come anywhere near the 320 to 325 area anymore. I think at this point it's pretty clear that we just shot through all of this, and that's going to be the area now that's going to turn into resistance. It's going to give us a lot of trouble overhead as we try to come up and bounce into that area. Now, what I was saying before about a sign of a possible bounce, a lot of times when I'm trading, but particularly when I'm day trading, and you have a strong trend in a day, one of the things you look for is capitulation. What that means, of course, is when you want one side of a trade to give up. In this particular side, you want the people that are hanging on for dear life, the buyers, you want them to finally give up and let this market drop. That way, the sellers could take their profits and new buyers could step in. A lot of times what happens is you get a big volume spike on a drop down, and that is often the capitulation bottom. However, in this particular case, it was so fast that wasn't going to be the bottom. And if anything, that was just going to be the pivot that was going to decide what we were going to do next. We tried to bounce. It really only lasted a couple of days. with a nice selling day in between, and then we drop below that. Now the key is a lot of times when you have these big volume spikes, you try to set up a bottom. The next drop down, if you see it with less volume, that shows a little bit less emotion, shows a little bit less panic. That's usually a decent sign that capitulation is near, because what you have is you have the big flush, and then you have the next drop down on lower volume, showing that there's less and less people getting scared and selling. Now that being said, we made new lows, which is usually not what you want to see. You want to see a bounce or you want to see the next drop to be right around the same level. We had it go quite a bit below that, so that is one warning sign that maybe we aren't seeing capitulation, but hopefully the lower volume gives us an idea that there's less of participation here as far as selling is concerned, and that maybe more people are willing to go ahead and step up and buy here and try to get the market to bounce up. Now unfortunately, even if we do get a bounce here, like I said, I think it's going to be short-lived. We're going to have this area, the lows from that first spike in volume around 285 are going to be key. You can see that was where we tried to get through yesterday, and ultimately we rolled right back over today. But that's going to be the key area for us to get back above. Once we get back above that level, then we're going to have to go ahead and start challenging the areas right above it, this 295 all the way up to about 305 or so. And I don't think that we're going to get past 305. I think at this point we have to accept the reality that the market is going to be trading below the 200-pair moving average until we get a little bit more resolution on what's going to happen with the coronavirus. And that means that we're going to still be in a market that's going to be looking for buyers and looking for value and looking to figure out where people are willing to step in, rather than a market that's looking for sellers, which is what a bull market is, right? Where it's just going up, trying to figure out where people are willing to sell. At this point, the market's going down, and it's trying to push us to figure out where we really are able to go ahead and step in and buy and support the market. And so far, we haven't really found a spot. So it's still looking, and it's still trying to really push the bulls and force them into placing some trades with conviction and establishing a new level of support. And again, we don't have one yet. So we have our levels to the upside, right? I think that's pretty obvious here. We have a very short-term level here around 285, but the more critical levels to me are going to be this 295 and then about 305. And those are going to be the key areas. Now, as far as support is concerned, well, we saw that a little earlier on the weekly chart. So I'm going to zoom out a little bit, give you a better idea. If we continue to drop, well, the key level now, there's two key levels. One is going to be 263, but if we hit 263, I think we're going to come all the way down to 256. And that would be the next real key level of support. We would hope that this would act as a good level of support. I thought the 200 would act as support, and I thought 295 would act as support. And it really only lasted a couple of days when we came down to that level. But considering the magnitude of the drop that we've seen, I would suspect that 255 to 256 would be a pretty major level of support, and we'll be able to stave off any more selling that we would maybe get, particularly if we reach that level pretty quickly. And I would expect, at the very least, the bulls to make a stand to defend that level, because that is a pretty critical long-term level. So that would be a good area to look at possibly looking at a reversal in the markets. Like I said, I hope that we're maybe at a reversal spot here. A lot of times the middle of the range is a pretty decent area, and as you can see that this area around 280 was a pretty critical line as far as a battle line, as far as bulls and bears were concerned over the last couple of years, and there was a lot of price action going back and forth between them. And while we find ourselves below that area today, I think if we can get back above that area, I think that would likely signal a nice bottom and would give us an opportunity to go ahead and maybe try to trade a bounce into 295 to maybe 300, but probably about 295 would be the key area here. Well, actually, yeah. So that's what I'm looking at with the S&P 500. It's not a pretty sight. As far as how we want to go ahead and trade, I'll get into a little bit more detail once I cover the four major markets. But I think at this point, it's what I wrote on Monday on my Patreon page. I think still applies and will apply for a while now. This is not a good environment to trade. If you're not forced to trade, you're probably better served to just kind of step aside and let the market stabilize or calm down a bit. If you are trying to trade this market, I think that shorting is probably a more viable alternative to going long. Unfortunately, the risk reward is very poor right now, and I've been kind of waiting. We went over this last Wednesday this idea of shorting names that are going to really get hurt by the slowdown, particularly in tourism and travel, stuff like cruise lines and airlines, anything related to oil and gas. But unfortunately, they've been hammered to oblivion, and we haven't had a chance to really go ahead and short a bounce because they haven't bounced. I still think those are probably the best trade ideas. For those that are a little bit more willing to gamble, you could look at a lot of little biotechs that are working on vaccines and go ahead and take advantage of whatever momentum comes into those names. Those are a lot more volatile and a lot more risky to play, but you can get some pretty nice rewards if they do work in your favor. And other than that, it's a matter of looking for long-term buys. You want to go ahead and take advantage when the market has these huge drops. This is a good time to go ahead and buy stuff like Amazon or Google or Facebook, the names that you know you could trust in the long run, and you could get them at discounts. And that's one of the things I've been focusing on. And really, just kind of stand aside and wait for the market to stabilize and show support. And then from there, you can go ahead and maybe trade a little bit more actively. This is why it's important for us to go ahead and try to make as much profit as we can when the market is behaving like it was throughout most of last year and the beginning of this year. You want to go ahead and take advantage of these huge market rallies, because eventually the market turns around and does stuff like this. And this is when you start to take a dent. And if you do lose, you're hopefully losing a lot of the profit that you made previously. And so at this point, like I said, you want to be more cautious. You want to go ahead and take advantage of different strategies that maybe limit your total risk or exposure to the market right now. Let's take a look at the NASDAQ. And you'll see that although the NASDAQ and the Qs have been hit pretty hard as well, relatively speaking, they're not nearly in as bad shape as the S&P 500, or for that matter, the Dow Jones or the Russell 2000. This is something we mentioned last week as well, the relative strength in the Qs. And if you're looking at bounce plays or you're looking for plays to go ahead and try to play to the long side, you probably want to look at tech names because they're the ones that are holding up the best. Now, still not good. You can see we're below the 200 pair moving average. We've lost a pretty good amount of ground, but when you look at the weekly chart, you can see that we're still holding up above most of the range that we spent the last few years in, right? So if you look at the range we spent from 2018 to most of 2019, and well, we're still above it, right? And we're still coming into what should be good support. The S&P 500 sliced right through it, but the NASDAQ, with the relative strength it's shown, is at least finding some stability at that area. So, again, tech, relatively speaking, has been stronger than the overall markets. It's still been weak, but at least there's a little bit of ray of light there as far as somewhere you can look at to kind of try to find a bounce or maybe move money into a different area. You want to look at some of the tech names, particularly the bigger tech names like the FANG stocks that you know are going to weather the storm a little bit better than some of the more obscure names. Overall, we have good support below us, and it's at the very least, if the markets do continue to drop, we could look at the NASDAQ as the first area where we will see a bounce. And if we do see a bounce, it's likely to occur anywhere from where we are right now down to this 188 to 185 area. We can make it all the way down to about 178. This is the area, relatively speaking, where the S&P 500 is right now. And I would imagine that's a pretty strong line in the sand for the Qs. And if we hit this area on the NASDAQ, that means that the S&P 500 probably hit the bottom of that range that we spent most of 2018 and 2019 in. However, like I said, you can see the volume pattern a little bit more clearly here. We had the big spike on the drop, and then we had a bounce, and then the next time down, it was on lower volume. It's still very, very elevated compared to what the average volume is for the Qs. But you see a little bit lower participation, a little bit less emotion on the second bounce as we come up to the 200. And like I said, I think that there's a decent chance we bounce here. The NASDAQ has been the strongest, relatively speaking, for a while. And if there is going to be an index that's going to hold above the 200 and try to stabilize and keep the markets from totally unraveling, it would be the Qs, and being able to hold above the 200 would be a very good sign. So if we can get back above that, I think that's a very, very good sign that we've hit a bottom. You can see we got above it yesterday, and we've kind of come back today, and you can see huge problem trying to hold above that area. If we can get back and close anywhere, say over 200 to 201, then I think we could say that we've probably found a short-term bottom, and we should expect the bounce coming up into this 209, 210 area. I don't think we make it all the way back to 217. And if we do, that would be a very good area to look at playing shorts again across the board, because we're going to have our moving averages, the 20 and the 50, curling right back down. And like I said, unless the news changes drastically, unless we find a vaccine for the coronavirus, unless something comes out where it's starting to spread a lot slower for some reason, I don't expect this pattern to change of us looking for lower prices. So I don't really think that we're really ready to bust back through these levels and start to make our way back into this gap. So I suspect that would be a very critical level of resistance, and one that we're probably not going to reach. We're probably going to, whenever we do find a bounce, it's probably not going to be a very strong bounce, and if it is a strong bounce, I doubt it gets past 217. So I'd be looking at this area around 205 to 209 as the first bounce area, and then possibly beyond that would be right around where I would expect the NASDAQ to start to roll over and head back to lows. If I had to gamble, I'd say that we have a better chance of rallying over the next couple of days than dropping, but I wouldn't expect that rally to last very long, and I wouldn't be shocked if we did drop. So I'm not saying to go all in on a long here, but I think that there's a decent chance we've sold off enough that I think there's a decent chance we bounce here, and I think what I see out of the NASDAQ is good, particularly if we can get back above the 200. If we close below the 200 today, then I would wait to see what happens tomorrow, but we really need to get above both the 200 per moving average and 200 in price, which are both right at the same exact spot right now. And that would be this is probably the one critical sign I'd be looking for a bounce in the market, is for the NASDAQ to get above that level. Of the four indices, if you're looking for a bounce and you're looking to figure out where a bottom is in the short term, getting the Qs back above 200, I think, is pretty much the tell that we want right now. And if we stay below that, then that's probably a good indicator that we're going to have to come back down and test lower until we can get back above that level. Now, if we look at the Dow Jones, relatively speaking, you can see the weakness, right? So, unlike the NASDAQ, which is around the 200 per moving average, which is around this area, as far as the trading range we spent the last couple of years in, not only did we slice through that, we already sliced through it pretty substantially. We've dropped below this key area, which was, relatively speaking, where the S&P 500 is right now, and we're almost at the bottom of that range. So if we go to the weekly chart and we take a look at where the Dow Jones is right now, you can see it's pretty close to the lows that we've spent the last couple of years in. So relatively speaking, there's a lot of weakness here. There's not a lot of Dow names that you want to be interested in right now. Now, granted, the Dow Jones has a lot less components than most of these other indices, so there's not a lot of breadth here, depending on which names get hit. But considering it's, a lot of it are industrial names, they're going to get hit by the market slowdown pretty significantly, and that's what's happening right now. And you can see it pretty clearly with the Dow Jones. I would suspect that 234 to 235 would hold as support right now. That's a pretty critical area, and this, I think, again, leads to the idea that maybe we do find a bounce, just because we've hit what is supposed to be very substantial support, or we're just right above it, but we're very close. And it would be a pretty ugly sign if we drop that. If we fell below that, so far the only index that has really created through a bunch of key levels of support has been the Russell 2000. That's not as concerning to me right now, because again, the Russell 2000 has been weak pretty steadily throughout the last couple of years, and so if it continues to drop, it's not as bad. But if we start to see the Dow Jones, particularly the Dow Jones, is kind of like the media darling. It's like whenever the media wants to mention whether the stock market's up or down, they usually talk about the Dow. They like to say the big numbers. 1,000 points down, biggest down day of all time. And so they really like to fixate on the Dow. And if the Dow starts to lose more key levels, I think it just goes to show the overall fear that is kind of running rampant throughout the marketplace, and it would not be really a good sign for the rest of the markets. Now, again, I personally prefer following the S&P 500 to get a good gauge of what the market's doing, but I like to follow all four because that gives me a better idea of exactly where strength or weakness is lying in the markets. And right now, the Dow Jones, which again is the one that everyone follows pretty widely, is looking pretty bad. And if we can't get a sustained bounce here, I think it would probably bode poorly for the other market ETFs as well. So hopefully we can get a good bounce here. This area around 234 is good support. If we lose that support, then it could get ugly. There's really no stable support levels until at least 10 to 15 points down, somewhere around 225 to 222, 221, somewhere in that area. And that's a pretty significant drop. It would also be the 200 period weekly average, which is a pretty critical zone that really we haven't violated in a long, long time. And that would be another ugly warning sign that the market is definitely heading towards bear market territory, depending on whatever your definition of bear market is. To some people, it's already in a bear market because it's below the 200 period moving average. But I think long term, we're still not in a bear market, but we're starting to threaten it, especially on some of these like the Dow that are starting to lose some pretty critical price points. So that's pretty critical. Now, as far as resistance, if we do get a bounce and it's very short-lived, then we won't get past 254 or so. If it's a stronger bounce, then I don't think we get past about 265. So that's going to be the key area to look for a rollover. If we get a strong bounce, I wouldn't expect anything above 265 to 270, just below the 200, and just above this area around 265. And that'd be right around where I'd start to look at shorting more heavily if we actually made it back up to that level. And then finally, we have the Russell 2000. Of course, this is the weakest of the four, by far. Really ugly. You can see the drastic gap down here. This is the one that capitulation means nothing when you've dropped this far down. If you look at it on the weekly chart, it's a disaster. We've lost a lot of key areas here. This area around 144 was hoping to be a good bottom level. Even this area around 133 we've lost. We're down back to the lows that we found at the end of 2018. This would hopefully hold as, at the very least, a temporary bouncing area. This would be the first sign of a market really going backwards. What we were talking about earlier with the S&P 500. In the long term, as long as we didn't lose this 2018 bounce, then we still were kind of making our way upwards. Well, the Russell 2000 is right around that level and ready to lose it. And that, again, would be the first warning sign that the market is definitely changed. Well, I mean, it's changed character already, but this will be the next warning sign that the market is maybe even heading lower and is starting to turn around and really get into bear market territory and uglier things of that nature. So this is a pretty critical area. I mentioned before how I think with the NASDAQ, that's the key index you want to watch if you're looking for a bounce. If you're looking for more selling in the market, the Russell 2000 is going to be the first to move. So this is the one you want to watch. If we lose this area here, where we are right now, and again, I think this is part of the reason why I think we're probably due for a bounce in the next couple of days, is because we've hit critical support on the Dow and on the Russell 2000, and I think the NASDAQ is holding up at a decent area, which is part of the reason why I think that we probably get support soon. But if we lose these levels, then it gets pretty ugly again. Like I said, if the Russell 2000 loses this, it's a pretty quick drop down to about 119, 120. And at that point, like I said, we would have lost basically the entirety of the price action we've seen since 2017. And that would be a negative. That would be a really big negative. And would likely signal the rest of the markets to have to drop lower to compensate for that. Now, if we do get a bounce, I expect the small caps to be the poorest behaving ones of the group. And I would not expect a huge bounce out of them. You can see there's a massive gap here that just really occurred over the weekend. And for us to break 136 is possible. For us to close the gap at 141 is probably not very likely, unless we see a very, very strong bounce across the board. And if we see a very strong bounce across the board, then I suspect that IWM will maybe close the gap. And if it does, that's around when I'd expect a rollover with the small caps. And I would not expect too much more beyond that, particularly 144. This area, I don't think we get past that. You can see this is where we tried to do sort of a double bottom. We failed. And then we had the big gap down on Monday. And I really don't see the small caps getting above that. So that would be basically the extent of any kind of bounce that I'm expecting on this particular index. Overall, like I said, it's pretty ugly. There's really not a lot to say that is positive here. The best I could say is that we're at support because we've dropped so quickly, and we're starting to get pretty oversold just because of how strong the market has dropped. Risk reward right now definitely favors someone willing to buy, However, I can understand not wanting to buy right now because the market is not in a good state right now. And even if we do get a bounce, I don't expect it to be a very strong or sustained bounce. So take that as you may. I think at the moment, if you need to trade, if you're someone that looks at trading as part of income, um, you you want to be very cautious. And if you don't need trading as income, then you probably don't even want to trade right now. Now that being said, I mentioned some trade ideas earlier. One other thing I've done is I think because of the extent of the volatility we've seen, I've been trying to get into selling a little bit more volatility, looking at stuff like shorting VXX. This was my trade idea last week, and it failed pretty quickly, but it's working pretty good this week. But last week it did not work very well, and that's one of the things you have to be careful with these types of trades, is to make sure you stop out immediately, and we did. And then this time around, we're hoping, because it was so extended as of Monday's drop, that it'll work in our favor, even if it is kind of coming back up today. But one of the other things I like to look at when a market is like this volatility at some point has to die down. So one of the things I like to do in these scenarios is I like to look at selling either premium or fear itself, which is why I was trading VXX. But looking at maybe calendar spreads or iron condors, looking to take advantage of volatility as it eventually starts to unwind. Now, unfortunately, I was a little early, but even when I was a little early, it worked in my favor, because you get a lot of leniency when you're selling volatility, and it's the kind of trade that has a higher probability of success. But I think now with the extended drop that we've seen, like I said, with the lower volume on the second drop, it's probably a decent time to look at maybe taking advantage of some premium selling if you have that kind of trading capability. If not, then like I said, you just want to be careful, and you want to make sure that you aren't getting overly excited. At the same point, you don't want to close everything you have here and then it bounces and you get stuck at the bottom. So at this point, despite the fact that we're down sharply, I don't think trying to raise cash is a good idea right now. If you want to raise cash, whether it's in your retirement accounts or in your regular portfolio, you want to wait for at least a substantial bounce to give you a better break-even point, and then go from there. And maybe you could put in some puts or put spreads to protect yourself. The difficulty right now is that if you're in it for the long haul, these are the kind of storms you have to weather, right? Because eventually the market does recover from this. And I think at this point, like I said, these are good opportunities to go ahead and look at some long-term names. And I'll get into that in a second once we cover the US dollar and commodities and stuff like that. Like I said, if you guys have charts that you're looking at, if you have any charts that you're worried about, start typing them into the chat. To give me an idea of what you guys are looking at or what you guys are kind of struggling trying to decide. There's a lot of charts that have gone through a lot of damage, so I can go ahead and look at for some support levels for you on whatever names you guys are focused on. Now here's a look at the US dollar. We finally got a little bit of a bounce. There's this weird wick here. I don't know that that's that significant right now, but you can see we had a massive drop. The euro had a huge gain versus the dollar. We finally found a little bit of a bounce. This looks like a little bit of a relief bounce, and the US dollar is really getting hammered right now. If we look at the euro versus the US dollar, and this is going to be the inverse because it's based off of the euro, so up is good for the euro. We had the euro bounce really strong, and then finally the US dollar was able to get some return movement on it. I suspect that this area around 118 is going to be good support for the euro now. And it looks like the euro finally did establish a bottom. A lot of this, of course, because of how the US dollar is behaving right now, with us cutting rates just to try to support the market. And I'd say there's been a pretty big shift in character here, and the US dollar has gained some weakness here versus the euro, and really across the board, except for the Canadian, which we'll get into in a second. Overall, this should bode well for gold and silver. We haven't seen that yet, really. But if the US dollar continues to act poorly, that should give gold and silver a better chance to rise more steadily. Now, as far as Forex is concerned, if anyone is a trader of this nature, I expect us to probably drop a little bit more and then eventually find some support and then establish probably a very broad bull flag or trading range here between about 114.5 and probably about 112 or so. Now, if we look at the US versus the yen, again, the U.S. dollar really struggled. Now, this one, of course, is in U.S. dollars, so down is bad for the U.S. dollar. You can see this broadening wedge just continues to get worse and worse. We finally had a huge, massive break through that. I expected this to be an area of support, so this kind of surprised me a bit when it did finally reverse. And at this point, this should show that this 107 area is going to be significant resistance, and I don't expect the U.S. dollar to get above that, like 107 to 108 anytime soon. So even though we had a very strong bounce now, I don't expect us to get back above or through that. And this inverse head and shoulders, which was a nice bottom, is not going to be an area of resistance as we come back and test it. You can see we're starting to struggle at the bottom of that. And I think once we get back to this 106.8, 107 area, that's going to be really stiff resistance. And should again show that the U.S. dollar is weakening across the board and is going to struggle to kind of maintain the trajectory it had before. Now, the one exception we have to that is the U.S. Canadian. And this, I think, is really more a function of oil prices really cratering due to a lot of slowdown in energy consumption. This is usually inversely correlated to oil, and we're going to get to oil in a second. You can see we had a big move up on the U.S. versus the Canadian, and then, again, this is really a function of Canadian weakness. If you look at at crude oil, we had a huge drop over the weekend, going from the low 40s all the way down to the 20s and 30s. This is ugly. All the oil names that we were looking to short, we couldn't because they dropped alongside this and never gave us a good entry point. I still think oil names are going to struggle. This is the first real big kind of area that's been impacted by slowdown in energy consumption and just slowdown in the world in general because of the coronavirus. And there's just a lot less demand for oil right now. And if we do get a bounce, if we somehow close that gap, I think, again, that's going to be a major level of resistance. And it's going to be an area where we probably see oil turn around and roll over. Now, that being said, oil has dropped so significantly this week that there is, for those that are willing to gamble, those that are looking to catch knives, you can look at a bounce here just because this might have been overdone, this drop. But I'm kind of, personally, I'm staying away from that trade because I just think that there's less and less demand for oil right now. And until we see something changing, in the nature of how the world is reacting to the coronavirus, I don't expect energy demand to all of a sudden go up in price or to go up. So I personally am not looking to catch this knife and to try to trade to the long side, but I could understand if someone was looking at it because there is a decent chance for a reactionary bounce to try to close that gap. But I'm not really looking at it. I think I'm staying away from oil names like Exxon or even just USO. Even if they do bounce, these are the kind of names I'd rather wait for a bounce and then short it rather than try to catch a bounce right now. Even though I do expect a bounce soon. Now, the other thing we want to look at is gold and silver. And as you can see, despite the fact that the U.S. dollar struggled over the last couple of weeks, gold hasn't done much. It's kind of just stuck in this range that it's been stuck in. I'm not really sure where to go with this. I think if the U.S. dollar continues to struggle, this should give gold a little bit of room to kind of take off again and start expanding and going higher. But we're not seeing that yet. We're just seeing GLD kind of going through one of these broad consolidation ranges, which it does very often. A lot of times it has moves, and then it kind of just chops back and forth. Then it goes up, and that's what it's doing right now. I suspect that it should go up soon, but at this point, it's in the middle of a range again. You got 158 as resistance, and you got 148 as support, and it's right in the 150s right now. So there's a little bit less room to the upside than downside, but either way, there's really not a lot of good risk-reward here on either side. And SLV is in a similar boat, and it's not really something I'm that excited about. As you can see, SLV, relatively speaking, actually much weaker, but doing the same thing, just chopping back and forth. It's closer to support, but because of the relative weakness, I'm not excited about going ahead and getting long SLV right now. It dropped a lot of key areas, and precious metals is not what I'm really focused on right now. Like I said, I think GLD, there's probably a good chance it moves upwards in the near future, but at the moment, I don't see anything there that really entices me to go ahead and try to play it to the long side. All right. So that covers it as far as what I was looking to look at. If anyone has a chart request, feel free to put it in. Like I said before, some of the things that I'm looking at right now are long biotechs, or short names that are struggling. So you look at my watch list, my recent watch list, and you have stuff like this. Obviously, stuff like INO, which um, has had a massive move recently, and it finally had a huge drop to start this week. But these kinds of names offer a lot of volatility. You can get a lot of moves up and down on them. The other thing I've been looking, the real thing I wanted to do was I wanted to short these when we got a bounce. But as you can see, you look at Norwegian Cruise Lines, you look at Carnival Cruise Lines, and there has been no real bounce for us to short, right? We had 3 or 4 days of sideways price action, and we just kind of cratered. And unfortunately, I probably should have been looking to short it as a drop below that bull flag, but I did not, and I missed a massive move on both of these. But this is my plan right now. Like I said, is to look at shorting names like Carnival or you know, airlines like Southwest or Delta. That are really struggling. That's one of the key areas right now. The other thing is you want to go long, or you want to maybe gamble on some of these biotechs. Now a lot of them are pretty risky. A lot of them is just people guessing on where the money's going to flow if there is a vaccine that develops. Yeah, and there's a lot of these names. I'm not going to go ahead and go through all of them, but you can see there's a ton of them, and a lot of them have picked up a lot of volatility and a lot of movement back and forth. Recently, and I don't think they're very good for swing trading, but I think they're very good for shorter, day trading or maybe trading for 1 or 2 days as you try to catch the moves back and forth. And then finally, the only other, besides maybe shorting volatility like we went over earlier, the only other thing you could do right now is you want to build your watch list, and this is something we always talk about when there's a market correction or market selling off. You want to look at names that you like in the long term, and you want to go ahead and how many times have you told yourself, oh man, I wish I would have gotten Amazon when it was back at this price? And then you never do, because when it's at that price, you're terrified, right? So you take a look at a weekly chart of Amazon, and you can see what it's traded at recently. And I think 1700 is a pretty critical area here. That's a good spot to buy. Anything lower, like around 16, would also be a good spot. And even where it is right now, to tell you the truth, is actually not a bad spot to go ahead and start to maybe put a little in. So what you want to do in these scenarios is you want to find names that you really like, and you want to put down stages where you could go ahead and kind of scale in. You don't want to just say, well, I want to buy Amazon at 1700, and then you wait for it to get to 1700 and buy your whole position. No, what you want to do is you want to say, well, I like Amazon. I think Amazon's at a good discount. Where would I start scaling in? And so maybe you want to scale in at 1800 and add maybe a fifth of a position. And then maybe as it comes down to 1780, 1770, you add another fifth or a quarter. And then as it comes down to 17, then you could add maybe another fifth or another quarter. Or you just keep adding until, and I'm not saying average down and just keep buying because it's going down on you. You want to set up a plan where these are the stages where I will try to buy, because as often happens in these scenarios, you can't really pick a good bottom. It's not easy to pick a bottom. It's not something that really is easy to predict. So what you want to do is you want to be able to spread it out over time, so that if you're early, you can keep adding as it drops to more critical levels. But you do want to have a final plan in place where you say, this is where I want to be in, and if it goes below that, then maybe I have to start looking at winding down and closing it or protecting it with puts or whatever it is that your long-term strategies are. But this is where you want to look at stuff like Amazon and Apple. There's a lot of people that missed Tesla recently, and Tesla's held up very well when you compare where it's been to what it's done over the last year or so, when it basically moved from 300 all the way to almost 1,000. But you can see it's gotten a huge discount here from 960 all the way down to the 600s. And so this is one of those, if you feel like, man, I missed Tesla and I wanted it for so long, well, maybe this is one of the areas that you want to start looking at scaling into a portion of it. Now, again, there's a lot of room, there's a lot more downside if necessary, but do you really think it's going to go from 1,000 all the way back to 300? It's a pretty good chance it will find some stability somewhere in the 600s or maybe the 500s. And so these are where you want to start maybe adding small positions and slowly building it up. Now, this is not really swing trading. I'm not saying to go ahead and buy a full position and try to trade a bounce back up to the 700s. Now, in Tesla's case, that's probably not a bad idea to take a swing trade here. Once we see maybe another candle showing some buying, maybe get back above 650, then you could take a swing trade looking for a move of maybe 50 to 80 points. But if you're looking at a long-term holding, you just want to buy a small amount, and the idea is that this is something you want to hold for several months or even for a year or two, because you think that Tesla's going to continue going upwards. And so a lot of what you want to do right now is you want to look at names that you feel are good in the long term, that you have confidence will be able to withstand what the markets are going through, and that you'll tell yourself 2 years from now, you're like, oh man, I'm so glad I bought it at that price, instead of telling yourself, oh, this is a stock that I wish I would have bought. And of course, the FANG stocks are always the easy ones. Now, Netflix, I think, has held up pretty well so far, because it's one of the areas where people are not going to see a big decrease in demand if they're shut in at home trying to avoid getting sick. But generally speaking, you want to look at names that you feel are offering you a good discount, and are names that you think in the long run are still going to behave well and are still going to do good for you in the future. So that's the general idea. That's what I have for today. So if anyone has a chart request, feel free to type it. Like I said, if you don't, then pretty much we could wrap it up here. Like I said, the market is not really in a good spot right now. You want to be careful. You want to make sure that you're not being too aggressive trading to the long side or to the downside, because we're so overbought, or so oversold right now, that we're still kind of struggling to find a bottom. And risk reward is poor for shorts. And while it's good for longs, obviously it's not a market that's very conducive to bounces right now. I do think that we probably see a bounce soon, and if that happens, maybe we'll get a little bit of different trading opportunities as we approach next week. But for now, I'm going to be very careful, and I'm going to trade very, very cautiously. And like I said, there's very little that I'm actually actively trading right now. And what I'm doing mostly is trying to take advantage of the premium as it hopefully starts to dissipate a bit in the markets. And I'm kind of hoping that I get a bounce to short, but so far that has not been the case. Alright, good to see you got out of UNG, Ray. Like I said, I think it's just a broken instrument, and in the long run it usually just goes down. And so it's just not something that I think is good to trade to the long side, because like I said, if you look at the monthly chart, you see it always has to reverse split, and it always decays, and it's just, generally speaking, unless you're day trading it, it's not a good place to be. So good job getting out and getting a little bit of profit, and hopefully you learned a lesson here, Ray. You should do this every single chart that you look at, and you love looking at these ETFs. Always look at the weekly or monthly chart of the ETF and ask yourself, is this a chart that is broken? Is this is part of the reason that I like to short VXX and I don't like to go long VXX, is because VXX is a broken instrument. And so it's not just a matter of me thinking that volatility is going to go down. It's also me looking at an instrument that I don't think works very well and trying to take advantage of it. And I know that in the long term it works in my favor. Now, I'm not trying to hold VXX for a week or a month or anything along those lines. But what it's, you want the current going in your direction, and a lot of these ETFs, they're broken, and they will inherently decay and lose value over time, and so, you know what, Ray? A lot of brokers won't let you short these. They'll tell you they're not available, or they'll say that you're not qualified to short it. I had a friend that tried to short VXX this week, and it said, oh, it's an advanced instrument, you're not allowed to trade it, and this guy's, he's an expert trader that trades a lot of accounts, and he has all the qualifications he needs, but they were like, no, you can't trade it. Also, I've had my brother short some of these, and what happens a lot of times is they'll tell you after a while, they'll close it and say, oh, we had to give out the shares, someone took them back, and so you can't hold them forever. But generally speaking, if you can get a short on these, you should hold it as long as you can until the broker just says, oh, the shares aren't available anymore. And the problem is, Ray, there's, like you said, if it's so easy, in the short term, there's always going to be fluctuation, right? So it's not a matter of, just because you short this doesn't mean it's going to work in your favor. In the long run, if you have a small enough position to withstand big moves, then you do. But so, for instance, last week I took a short, right, at 23. But it's not always easy, right? Look, I was wrong in 2 days, and it immediately gapped up to 25, and I had to close it. I took another short this week in the 37, 38 area, and look, I'm still basically about break even, even though it worked well yesterday, but I'm still about break even. In the short term, it can still go back and forth. But in the long term, you know that it's going to basically go down. And so when you see an instrument that's broken like this, it doesn't guarantee that your short's going to work. But what it does tell you is that your longs are going to really struggle to work because the instrument sooner or later will turn around and drop. So I'm not necessarily saying always short these. What I'm saying is don't try to take them long because you're going against the current that way. You know, the odds are better for you to succeed trying to short it, but that doesn't mean it's going to work every time. You're still going to struggle because in the short term there's still a lot of fluctuation. Yeah, they do stuff like that too. They'll raise the margin. So you had the margin raised on, what is this an over-the-counter stock? Gee, I don't know which one JUNG is. I don't have that here. Unless you mistyped it. Oh, JNUG. Oh, there you go, JNUG. Yeah. And well, and yeah, you can see, by the way, this is again, Ray, why I always tell you stay away from these triple leverage ones. When the moves do turn around, they're pretty quick again. So this is pretty ugly. From where it was in the hundreds all the way down to 42. Yeah, and this happens. So this is part of the reason, Ray, again, why I don't like some of these triple leverage funds and why I tell you always look at the weekly or the monthly so you get an idea of what you're fighting, you know, and why it doesn't work in the long run and why you shouldn't hold these. Look, I have a trend line here. This is because it reverse split and my trend lines don't adjust with it. So I have trend lines way down here from the last time before it reverse split that I'm never going to see again. And this happens all the time with these names because they're inherently going to decay and lose value. And so, as you well know, just because they're broken doesn't mean you could just short them into oblivion because a lot of times they have bounces that make it hard in the short term. But in the long term, they always work against you, which is why I always tell you not to hold these long term or to trade them in the long term. Now that being said, I'm not against trading these in the short term, but I think once you hold it past a week, you're putting yourself in jeopardy of the ETF just basically decaying on you, and at that point, I think it's almost like holding an option where it's just going to lose value over time. Yep, if you just did the George Costanza and you just did the opposite, you'd be in good shape. All right, that kind of covers it for today. Like I said, if anyone has any questions that they feel like they wanted to ask and they couldn't ask, you can always ask me on Twitter. You can always follow me on Twitter and just ask questions there. You can join us in our Discord chat. You can email me. Be more than happy to answer questions in a more private area if you don't want to publicly ask these questions. Ray, the problem with this JDST is the same thing. It's gonna decay as well. So you're asking, should I do the opposite? Just short. If you can short them both instead of. But don't try to go long both to offset each other. Then you're just putting it's broken. It's going down. It's always going to go down. So you don't want to try to offset it by buying one or the other. You want to offset it by shorting one or the other. And if you're not allowed to short it, then don't short it. Just stay away from them. And I think a lot of brokers won't let you short them both, by the way. But if you can, then you know that's free money. But all right, that covers it for today. Have a good rest of the week. And Ray, if you want, I guess you can investigate that a little bit more and see if your broker allows you to short them. And if it does, then you should probably. But you have to be careful, Ray, because you have a problem abandoning your trades, and shorting stocks, shorting triple leverage stuff is not a good idea if you don't have the discipline to close it when you're wrong. And as far as any word from Frank, Frank is I don't know. I guess you haven't heard yet. I don't know how you haven't heard this yet, but Frank took a lot of people's money. He was trading money and he ended up stealing it, almost like $2 million. We're not going to hear from Frank anytime, really ever again. So, I mean, at this point, he's gone. He's in the wind with people's money. They couldn't get it back, so There's not much that we're going to hear about him about that. Okay. Um, so for anyone else that's in here that's wondering where Frank is, he's gone. And these people are, there's quite a few people that lost a lot of money because they gave it to him to trade, and they're not going to, it doesn't look like they're going to get it back. So, um, yeah, I don't know. I don't know how you hadn't heard that yet, but yeah, he's yeah. So that whole thing about the stroke was fake. But all right, I'm gonna close it up now, Ray. If you have any other questions like that, you can email me. But yeah, that's what ended up happening. So like I said, hopefully you guys have a good rest of this week, and hopefully by next Wednesday the market's in a little bit of a better place. Um, a better place where we can maybe get some different types of trades in.